Um, my first rule is always measure price, and by that I mean how far has the market gone from a low to a high on any given trend. There's a lot of cross currents in the market, as you know. There's times of the day when you don't want to be in there, and so what we're looking for are the two key trends a day, and sometimes there's three, sometimes even more. But again, you have to remember the philosophy behind this kind of trading. You want to get in there, make the money, and leave. And if you do this day after day, it really adds up. With the S&P having ranges in excess of 1,000 points a day, if you can get just 200 or 300 points a day and you're doing multiple contracts, it really adds up. $3,000, $4,000, $5,000 a day even sometimes, usually using small orders, 2s and 3s and 4s. So anyway, in measuring the price, we have rallies and declines, and you want to measure a rally from the lowest low to the highest high. That's what I mean prior to a counter trend down. A decline, of course, is measured from the highest high to the lowest low prior to the counter trend up. And you got to remember there's always going to be counter trends in the market. Whenever a market goes up, inevitably it will come back, even if it's going significantly higher later on. And as you'll see as we get into the material, this is what you're looking for, is the move up for the counter trend down, to get in, to capture the move on the second leg. Let's move along here and we'll see what a leg looks like. On this particular chart I've identified, this is on page 12 of the manual, I've identified a leg from a low to a high, and I've measured it as 5.2 points. And all I'm trying to do here is illustrate what a leg looks like as one part of the trend. And here I've used 5-minute bars. I use 1-minute bars to trade primarily, but I use 5-minute bars because they're easier to see the long-term trend during the day. And that doesn't mean you can't use 3-minute bars or 7-minute bars or whatever. But if you don't have the technology, of course, you can't do this. So it's important to have that. And anybody who's read my book, Profitable Day Trading with Precision, will know that I really think that the technology has leveled the playing field in recent years. When I first went to the floor in 1980, the floor traders had a big, big edge that they don't have anymore, partly because of the introduction of electronic trading, but primarily because of the technology. Now, a guy living where I live in Florida or Montana or California can see the trends even better than the guys in the pit sometimes, because they don't have the technology that the off-floor trader does have. As a result, you see C prices have come way down in recent years. Traders on the floor are opting to go upstairs, as it's called, to trade off the floor. And I don't think I'd ever want to trade on the floor knowing what I know about how the trends look on the charts on the screen. So this is a big advantage that the off the floor trader now has. On 13, I've identified a leg down, what it looks for. And again, a leg is a significant move in one direction. And you got to remember why I'm looking for this. The reason I'm looking for it is I want to buy as close to the low as possible, sell as close to the high, and I don't want the cross currents coming in. Because when the cross currents come in, it means I'm giving back paper profits. I want to identify the trend, I want to get on it, and as it starts to end, I want to get out. And it's important that I get out as it starts to end and not after it's ended. Because once it ends, what will happen is it'll go the other way in a hurry. So I want to anticipate where it's going to end. Here on this 5-minute chart on page 14 in the manual, you can see a significant decline into the close. This will vary from time to time. Sometimes you'll get a market that's good trending in the morning and not so good in the afternoon. And other times you'll get it good in the afternoon and not so good in the morning. But you got to remember this will change over time. And so you have to be flexible enough to identify that. or recently we've just had wonderful trends in the afternoon. Earlier in the year, there were no significant trends into the afternoon, and the only way it would go would be up. So if you did get a downtrend, there'd be no follow-through. So you have to learn to adjust to what the market's telling you. And there have been a number of days recently where I live on the East Coast, I wouldn't go in the market till after 3 o'clock East Coast time. And on the East Coast, the market closes at 4:15, and sometimes even as late as 20 minutes to 4 to get that pure trend. But believe me, when the day is over and you've got that winning trade in your account, it's a lot better than being in all the choppiness. And again, I want to stress how important it is to get in there when the market's trending, and how important it is to have the discipline to stay out when it's not trending. And we're going to talk about that as well, how the noon hour traditionally is a counter-trend time of day where the volatility tends to slow down and it just gets choppy, which is not a good time to trade. On page 15 again, and I realize this is a little redundant, but it's important to identify these trends. We have a leg, and then we have a second leg, which is a lot bigger. Time and price says that it should take so much time to go so far in terms of either rallying or declining, in that these tend to be comparable, not so much from day to day, but within a day. And this is where it gets tricky and why it's difficult to develop software to trade this way. When you develop software, you say, well, if it goes 16 minutes up and there's a pullback, I want the next 16 minutes. But the next day, it may not be 16 minutes. It may be 9 minutes. It may be 7 minutes. So every day is time and price specific. And you have to remember that every day is a new day. What works on Monday won't necessarily work on Tuesday. And you have to be able to adjust. And this is why so many new traders have problems trading, because they tend to do the same thing. What worked yesterday, they think will work again today, and it really won't. You have to be flexible enough to change. Now, I'm getting a little ahead of myself, but I do want to stress the importance of the legs, the equilibrium, and what you're looking for. Markets, why do markets go up and why do they decline? To understand this, you have to understand how the floor works, what the psychology of the traders are, who's in trouble, and what will cause the market to react the other way. On the floor, there's a bid and ask. The buyers bid, the sellers offer or ask. Hands out, selling, hands in is buying. They always say at when they're selling. If the bid is, to take just a rough number, is half or 0.50, it'll be 50 bid or half bid. If another trader in the pit wants to buy more, he has to take it up because he can't bid it lower. He can only bid it higher. So if it's half bid and the sellers aren't coming in, he takes it to 60. And how does he do that? He yells out 60 bid. Now all the half bids are no good anymore, and they have to become quiet because someone has taken it up to 60. Now what happens if somebody else wants it even more? He'll take it to 70. So this is why you get these moves in the market: half, 60, 70, 80, 90, even bid. It'll go up because the buyers want to get in, they want to buy, and the only way they can do it is to bid it higher. They're not allowed to bid it lower in the immediate time frame. So if it's half bid now, somebody else can't yell out 40 bid that second because it's half bid. It works the opposite way in selling. At even, at 90, at 80, at 70, at 60. This means the sellers want to sell, and to do that they will take it under the prevailing offer or lower. This is why during the day you have all these mini panics, because when they run the stops, guess what happens? Let's say the high of the day is even, and you've got to stop to buy it at the higher 10 or the higher 20. Somebody takes it to even, then somebody bids 10 for it, and the broker with the stops, or brokers rather, all start bidding because the stops become market orders at that point. So what's going to happen when it gets there? The market's going to run because you told your broker when it gets to 10, I want out, I want to buy it. And what happens? 10 bid, 20 bid, 30 bid, 40 bid, anything to get that seller to come in and agree with the buyer on that price. And this is why you get these mini panics, and it's also the reason why you often want to be taking the other side at that point. When the panic comes in buying, you want to be selling into it. Because what will often happen is the market then will retreat and go the other way. So that's how the prices move up. Now what happens when you have a rally? Prices are bid up, and sooner or later they're going to come down. Why? Because the people who bought it lower have to become sellers to get out. And everyone wants to maximize their profit. So what happens when sellers come in and all of a sudden the buying ceases? The sellers have to offer it down to draw out buyers. Now you multiply this by thousands of people trading at the same time and you get the rundown. So you get what I call an equilibrium point will eventually be established as the market starts to come down. So you get the rally, you get the counter trend down, and then you get the second leg with the rally up. And that's where sniper trading wants to come in and start buying typically. Now a question that comes up all the time is, why don't I get the first leg and not just the second? Well fine, I try to do it myself, but it's not easy to do because you don't know which way it's going at that point. The first leg tells you the direction. It gives you other important information too. It tells you how long it took to form that first leg. And then you've got the pullback, the equilibrium area, what I call the consolidation. And it's in that area where prices should stabilize prior to the second leg. I'm getting a little ahead of myself, but even still, the equilibrium point is 2 consecutive closes at the same price on 2 bars. So it can be 2 1-minute bars, it can be 2 5-minute bars, whatever you're watching. Though I tend to look on the 1-minute bars for this.